Money market rates are going down, and here's why. So recently we've seen the interest rates on the money markets coming down. So today we just break it down, like where is this coming from. Recently we saw money markets offering rates up to 18%. That has really gone down to the first money market having a rate of about 16%. So what is really going on in the market? This is all goes down on where the money markets are allowed to invest their money, that is by the CMA, and that is mostly in the government papers, that is short term, that we have the T-bills, the 91 day up to the 1 year. Then after that, they expand the tenor up to 18 months. So basically, money markets will invest in government papers up to 18 months. So where does money markets invest their money? So we have, according to the CMA, we have the government papers that are short term up to 18 months. Then we also have other instruments that are given a lower exposure, like commercial papers and such. So given that the main asset class is the short term government papers, and we saw the CBK cut down the CBR rate, which is now used as a market reference rate, as a benchmark for the government papers, because when the rate is higher, now the government papers will be at a higher rate. So from that, we've seen the government papers, the T-bills, come from a high of 17%. Now we're talking about 9%. So what that does, it will trickle down to the money markets, because now you have to invest in the same papers, but now they're offering a lower rate. So that's why we've seen now I'd say they are more like normalizing, because it's the normal thing for me, because having a money market offering say 18%, and it's investing in rather risk-free rate, a risk-free asset class, then where are we going to put our money other than the government papers? Everyone will take in their money there, and the economy will be very imbalanced. So now the rates are down. Is it a good thing or a bad thing? So what happens to the CBR rate when it comes down, or rather when it's lower than it used to be? We saw it at a high of 13%. Now we are at 10.75%. So what is that supposed to look like in the economy? We expect the economy to be in a better place. So I'd say it's a good thing, because when the rates are lower, that means the banks will now lend at a lower cost. So the cost of borrowing for the private sector is lower. So that means people will borrow more, and that means the activity in the economy is better, is higher. So that leads to more economic activity, more economic growth, and now that goes ahead to spur the equities markets, the real estate markets. Let's say like when the government papers were 18%, why would I go and take all the risk and invest in real estate? So the other sectors in the economy were kind of chilled out and asleep, because people are not willing to take the risk and go the real estate side, because why would I, and I can still get 18% in government papers. So we expect to see more activity in the real estate, the equities markets, because the equities markets respond to the lower lending rates. So companies are not now able to borrow more, do more activity, and have more profitability. So that drives the stocks prices a bit high, so creating that activity in the equities markets. So in terms of the investor, I'd say it's a plus for an investor, because now you are able to put one foot in the equities market. You can still invest in a rate, because now you have that freedom, a bit of freedom to diversify your investment, because the equities markets are doing okay. You can still do the government bonds, because we term them as low risk. So we cannot say like you do away with the money market, because a money market will give you a capital preservation, where if you give them 1,000, you don't expect less than 1,000. If you go the equity side, you can get less, because we say the risk is higher. So you can still retain your money market for capital preservation, for low risk investment. You can still now do your equities investment because we expect a better growth in the economy and better performance in the equities market. You can still get some exposure in the real estate. So I'd say it's a good thing because it will give you a balance and diversification of your portfolio. To wrap it up, money markets, I'd say, especially for a starter, and even someone who has been in the industry, you know your thing. I'd say it's a thing that you need to have, like, always in your portfolio, because it will give you exposure to government bonds. It will give you exposure to, let's just say, very low risk investments. And when you're about to invest in a government bond as a person, as an individual, you may not be able to raise the 50,000 that is the minimum investment in a bond. So a money market will give you that exposure, that return from the government papers, preserve your capital. For the money market, say like our money market, that is a Cytonn money market, you still get the liquidity advantage. You can put in your money anytime, you earn your return, and you can get out your money anytime. In the middle of the night, you'll still get your money. So a money market will give you the advantage of diversification in the various investments that the fund has made. You'll also get the advantage of liquidity, and we cannot say the return is bad. 16% is not bad from the Cytonn money market.